The 10-year T-bill has been floating around 3%. So that is the long-term expectation of the interest rates that's required to have sort of normal inflation. But what if it's 4%? What if it's 5%? If that ends up being the case, it'd be a huge downside surprise to the stock market.
How would you define that? 10% pullback, 20% pullback from here?
You have a bunch of things. Look, we talked about this other issue before as well, which is if you believe the stock market is fairly valued, you have to believe that prices are right and that the earnings are right. So because it's effectively, it all boils down to the price earnings ratio of the S&P 500. And I'm going to still maintain that the E is wrong. The earnings are wrong for most of these companies. So why? Well, one is that when these companies start to report their quarterly earnings starting in the next few days, the year-over-year comparison is going to be to the numbers that they posted in Q2 of 2021, which by all accounts was a blowout number. Why? Because the number before that was 2020, where their business was zero, right? So you have these incredibly tough comps in terms of growth percentages that you have to reach, which I don't think are achievable. Second is everybody's costs of making and selling things is going up, which stands to reason that unless you raise prices quickly enough, your profits will go down. Third, if you actually do business outside of the United States, the US dollar has rallied so much that you actually have less income that you're making in these other countries when you convert them and bring them back to the United States. Now, most people look through that last issue, but the point is if you add this all up, there is a reasonable probability that all the E's are wrong, in which case we have to reassess what the right E should be, in which case, what is the right PE?
Yes, and earnings are a function of what you spend and what you make. So that's why we see so many companies doing layoffs, cutting people. Microsoft, Google, everybody is now putting people on notice Jason, that they have to perform.
They're firing white-collar labor, but they're hiring blue-collar labor faster. And we're actually going to see a downtick in productivity, right? You're replacing a person that may sit down at a desk and use a computer 8 to 10 hours a day to do something, but you are hiring a lot of people that may get paid by the hour or may get paid a fixed salary if you do the right kind of work, but that qualifies as more contractual blue-collar labor. The difference in that is a productivity difference, ultimately.
Yeah. And just so everybody knows, for PEs, price-earning ratios over time, here's a quick chart for you. We're currently, and this is for the S&P 500, we're currently at 20 or so. We have twice in our lifetime hit that 13, 14, 15 level. So we could have a 25% correction from here in the stock market. If you look at the highs, our recent high in December of 2020, we're at 38 price earnings ratio. We've fallen from 38 down to 20, almost in half, and we could still go down 25% from here. And that would basically not even set a new record. That would just hit the last two crises we had.
The thing that I think will work against this happening, Jason, yeah, you're right. Maybe it goes to 3,000 or 3,200. But if you look again today, and what I mean by the market has roughly shaken this off, like the fact that the markets right now, as we talk, are essentially down half a point. The S&P is down 12 points. It means that they are looking for any and all reasons to say this is a solved problem, move on, nothing to see here. Now, that is a psychological reaction. Most of that, if you actually, I called a friend today and I said, where are the flows? And he said, retail right now is where all the flows are, meaning it's retail that's buying. They're in the 30th, 35th percentile of where they normally buy, which is a pretty healthy signal.
Wait, explain what you mean. Who's buying?
So the way the market works basically is you have buyers and sellers. And to make it really simple, you have hedge funds as one class of buyer.
Sure.
You have ETFs, but they're not really
exchange-traded funds.
Yeah, but they have fixed strategies and they're hedging, they're moving, but whatever. And then you have retail. Okay, so it's retail and hedge funds. Those are the two main pockets of where the flows come into the stock market from. And you can get a real sense of what's happening, what the psychology of the market is, if you see what those flows are. And right now, what we see is that hedge funds are largely on the sidelines. What that means is they are, well, they've been so battered and bruised. In some ways, I think they're licking their wounds, but they're mostly waiting. They do not find a compelling reason to buy.
But they have to buy at some point, right, Chamath? This is their business.
No.
They find other opportunities, right?
Their business is to make money relative to their index. And so if their index gets torched, them doing nothing makes them look like geniuses. So they don't necessarily have to buy at any point. They just need to make money in the end. So right now we're in a situation where the markets are looking for a direction. Retail seems to think that direction should be up. Hedge funds don't have an opinion, are saying, we're just going to wait this thing out.
Okay.
Meanwhile, the data, at best, is a question mark. And I think that's the tension we have right now in the stock market is the psychological desire is for this thing to be over. Meaning, I think people want to hear inflation is done. We're starting the recession. Give us 3 or 4 quarters. We'll be out. Here's a steady state interest rate. Let's go tech.
People want to accept the reality. Friedberg, does that mean that we're bouncing along the bottom for the next year and then this is the time or the opportunity to buy? I don't want to give financial advice, but what are your thoughts if hedge funds and retail are waiting in the wings?
Are you asking me if the stock market is at a bottom?
Are we bouncing along the bottom? Yes. Or how would you describe the next year if you were to look at it? What do you think?
I'll tell you guys some stories. I went to a conference in March with a lot of fund managers, probably managed several $1 trillion in total. People were like in shock and awe at that conference because they had taken such significant write-downs and they were still getting written down. So all their investments were off. They were off 40% from the peak. They were freaking out. Things were collapsing. No one was doing anything. They were all sitting on the sidelines, hanging out, waiting. I went to a conference last week, and so the tone and the demeanor was just like morose. Last week, I went to a conference with a lot of managers, also probably managing trillions of dollars across the pool. And people were they had accepted this new reality and they were willing to look at new things. And they were no longer engaged in trying to shore up just their portfolio. And a lot of the stuff we talk about, which I think is tactical on the ground, how do we deal with our businesses and our portfolio of investments that we actively work with in the private markets, they were much more interested in starting to explore and think about new things. And I hadn't seen that 3 months ago. So
that's a positive sign.
From a market participant point of view, I think that folks have, accepted a new normal, an inflationary normal, a high volatility normal, a normal of uncertainty, a normal of kind of recession. And as people have started to internalize that new normal, I think they're now starting to say, okay, what should my action plan be? And that action plan is, I've got trillions of dollars of capital sitting on the sidelines. What should I start to do with it? My very anecdotal experience has been that significant market participants, I think, are going to start to perk their head up this quarter and start to think about doing new things. What that translates into in terms of stock price movements and indices, I don't know. I've always said that there's going to be a huge variation in outcome during this year. And some industries, some sectors, some types of businesses will outperform others. And so I don't want to create generalized statements about indices, but I do think that capital activity is going to start to come back this quarter, where people are going to start to think about what to do rather than pull everything out because of the massive shift that's happened in the past couple of quarters.
Sachs, what are you as a market participant thinking? You're looking at Series A, maybe doing some opportunistic flat rounds. Are you looking at the startup market, mid-stage market, and saying, hey, this is an opportunity. Maybe I should start looking to put some money to work in the next 6 to 12 months. Or
yeah,
are
of course.
you...
We're still investing.
You're still investing.
Of course. Yes,
so as a
of course.
market participant, you're investing. What are you seeing?
We're investing, but we see that the pace of deal making has slowed way down because founders know that valuations have gone down. The fundraising environment is tougher. So last year they're raising every 9 months. Now they know they should probably be raising it once every 2 years. So the pace has slowed way down.
That's a good thing?
Yeah, I think
it's healthier.
It's healthier. Yeah, it's more normalized. Last year, the companies that could raise did raise. They have big war chests. So I think there's going to be a delay. It's definitely a slower period. We've done a couple of growth deals recently. I think the fact that Tiger and the other kind of crossover investors, the fact they've pulled way back from venture markets gives smaller firms like us an opportunity to do growth deals. So
how did you make the decision to invest in those companies?
They're both companies we've known for a long time, have wanted to invest for a while. The opportunity arose to invest, and it was way less competitive than it would have been last year. So this is what
we would call opportunistic. You knew the firm, you had high confidence in them, and opportunistically, they need money. Yeah,
we've basically done 2 deals in the last 4 months. And
what was your pace, let's say, 18 months ago?
It was a little faster than that, for sure. There's just more deals happening. So
interesting.
If you want to think about tail risk, where there's some event that can massively shift the market, the indices south, right, make them go negative, and everyone pulls money out of equities or out of bonds further, there are some of those events brewing, right? We've talked about the consumer credit
Taiwan
risk. We talked maybe Taiwan, maybe this emerging market crisis that may be emerging. These are like little turtles putting their heads out. They may not come out, but there's enough of these turtles now circling you that there's still reason to be wary. Whereas
let alone a black swan event, which would be
these
a
aren't
fine.
even black swans. These are just like significant
known risks.
These are known but significant risks, right?
Yeah.
And if any of them do take off, we're already in a very shaky kind of period right now where we're trying to manage inflation and recession, and businesses are trying to raise capital. And again, this is why a lot of biotech companies are trading below cash, because the expectation is they're not going to be able to raise capital.
And they'll go out of business. It's basically,
so any
they're
one
going
of
to
these
go out of
things
business.
pops up, boom, you start to see things go. So I think that's the reason investors, portfolio managers are not going to rush back into putting more money into equities, is just sitting around waiting to see how a few of these things resolve before taking action.
But there are companies that do not face the risk of ruin. They just are sitting on so much cash, they have so much revenue that there's no chance of that happening.
Yeah, I've always said it doesn't matter. If you find a great business and you believe in that business over the very long run, you don't need to worry about timing the markets. You put money in that business, as long as you get a fair valuation for it today relative to what it should be priced at based on what markets are telling you today.
20 PE would be more than fair historically.
Maybe, who knows? But like whatever that is. But if you find a great business that you think is going to compound value for you over the very long run, market cycles don't matter.
And long run, you mean a decade?
Yeah, call it a decade. And Sachs's business that he's invested in, these are tech companies that I don't think they're planning to go public next year. He's making an investment in a business that he considers to be a great business that can compound value. Not compound valuation, but compound business value, meaning they can do something more valuable next year than they were doing this year and continue to accrue an advantage in their business that allows them to accumulate earnings over time, or accumulate revenue that ultimately translates into earnings over time. And there are many businesses that are public that operate like that regardless of any of these turtles popping their head out, those businesses will perform well over the next decade. And I think that's always a great place to invest.
So we basically went from D-Day, Saving Private Ryan and Scene in the first quarter to now people have accepted we're in wartime and we're not shell-shocked. And some people are looking for opportunities. Chamath, you found an opportunity. Maybe you could talk about the deal you did this week.
I tend to agree with Friedberg. You find these businesses that you like, and if they appeal to you and you do your work, that's the most important thing. You shouldn't be afraid to write a check.
Can you stop right there and just define what you mean by do the work? Because everybody hears you say that. What does that mean for an investor, for somebody like yourself? What does doing the work mean?
It really depends on the sector. So, for example, when I was trying to underwrite Open Door, what I really wanted to understand was, what do take rates look like in all these various markets? How do I think take rates will evolve here? How do value-added services work? What kind of margins can you sustain? What is the sensitivity of different parts of the real estate economy to interest rates? That's an example of work. When I was underwriting SoFi, what you're trying to understand is, how do banks generate net interest income, NIM? How does that change over time? How does bank charters change that? How do loss rates change in times of economic expansion versus recessions? How do you price all of that into a fair value of a business? It's just a lot of really detailed diligence to understand all the facets, or as many of the facets as possible, of a business that allow you to have a clear-eyed sense of what's possible. Then there are others, which are pure technology bets, where you try to understand either the biology or the technology. So in the case of the deal that I did today or this past week, myself, a bunch of family offices around the world, led by a great chairman, Pablo Lagarreta, who started a phenomenal business called Royalty Pharma, which is public, Carlos Slim, a bunch of folks. We put in about $500 million to help advance into clinical trials this business that's trying to provide a solution to chronic kidney disease. So in that example, it was a lot of scientific diligence on what are the existing solutions, how do they work, what is the mechanism of action inside the body, how is this the same or different, what does the early data say, how are the clinical trials structured, and then you come to an answer. In this case, I decided the bet was worth taking, and like Friedberg said,
The name of the company and what they do?
the company is called ProKidney, and basically the idea is that it uses your own body to help heal your kidneys if you are on the verge of chronic kidney disease or you are getting dialysis, etc. And essentially how it works is it removes cells from your body, from your kidney actually, and then it does basically puts it into a centrifuge, does some specific things to it, grows and amplifies certain cell lines from your kidney, and then re-injects those back into your kidney and tries to improve what's called your EFR, which is your estimated glomerular filtration rate, which is essentially a number that we can use to estimate how efficient your kidneys are. And essentially, when you are a type 2 diabetic, or you have chronic kidney disease or kidney failure, or you're on dialysis, it's because that filtration capability has failed. And so all these toxins are getting pushed back into your body. And so, yeah, we took a $500 million shot. I wrote a $125 million check. I hope it works.